All set.
Good morning.
Actually, before you start, I want to make a note that these meetings are recorded and live streamed. We're having technical difficulties with the live streaming piece of it. So today's will just be recorded. It will be posted. Anyone can view it afterwards. We do apologize for anybody that wanted to see the live stream, but it's not available today.
Thank you.
Can I ask one quick question? Do you have to wear these the whole meeting?
Huh?
You have to wear these the whole meeting?
Well, it depends on who you ask. If up to me, I'd say no.
I'll say we'll keep going at this pace right now and see where we are next month.
Go ahead, Bob.
Good morning. I'd like to call the pension committee meeting to order at this time. Now I will turn the meeting over to Alesco Advisors. Good morning.
Tim, you're muted.
I'm on mute. Sorry about that. Yep, sorry about that. Good morning, everybody. I hope all of you are well. I just noticed that I'll need the to be made the organizer or to be made the presenter so I can share my screen. If that would be okay. Let me pull up the report for everyone.
He does know I don't know how to do that, right?
We need for the meeting. I can go along with it. Otherwise, because I think all of you have copies, but for those who are remote, might like that. The report.
I can pull it up. Hold on one second, Tim.
Thank you very much. Sorry about that.
No, it's my apologies. It's user. Go ahead. Just tell me what page to go to.
Okay. So, put it back up. Oh, so you're going to do it. Got it. You can start just on the overall asset allocation page. That's fine. So it's page, for our report, page 1. Perfect. Yeah, just that first one. So you can go to the next page. I just want to wish all of you, Happy New Year. I believe that January is almost over, but I hope the year is off to a good start for Centro and personally. We've seen a little bit of weakness in the stock market this year right out of the gate, but that's certainly something to be expected after having such a strong year last year. The returns were quite exceptional in the stock market last year, and so some weakness after that is certainly something to be expected, and you'll see that in the performance of the pension plan in the report that we're covering today. Just as a quick housekeeping item, I'll cover the asset allocation and the performance of the pension plans, and then Jim will have some comment on the capital markets review, what's happening in the market, and the positioning of the pension plan holdings for Centro. So if we start off here first, just taking a look at the non-salary DB plan, we see the asset allocation. Actually, if you can go back one page, please, the overall asset allocation. Yeah, perfect, thank you. So we see that the overall asset allocation of the pension plan with equities at 66%, which is towards the top end of the investment policy range. Real return assets come in at about 7% towards the bottom of the range, and those are inflation-protected securities. And fixed income and cash overall come in at just about 27%, right in the middle of the IPS range, but everything in line with the investment policy parameters. We can go to the next page. The equity allocation has been steady over the last quarter in terms of Alesco not making any changes in the asset allocation. But we were able to make some rebalancing trades in the fourth quarter into international and emerging markets. So there were some trading involved related to rebalancing in those asset classes. And that's actually been beneficial, having that discipline to rebalance as we move into the early parts of this year, because we're seeing some relative outperformance of both emerging markets and international. So that discipline from a portfolio performance and diversification benefits so far this year. We've also seen some outperformance in the value components of our portfolio so far this year. just an interesting connection to the potential for higher interest rates and some relationship in those changes that we might see coming this year. So the large cap value and on the international side. Aside from that, the allocation in equities has been. We can go to the next page. In terms of the fixed income holdings, we actually did make some changes to the pension plan holdings during the fourth quarter. We made some trades to further reduce the risk in the bond holdings, lowering the duration of the bond holdings by about a quarter of a year. And to accomplish that, we reduced our exposure in the broad bond market, the total bond market fund, by about 10%. And we also sold our floating rate corporate investment grade bond fund, which was about 10% of the holding, because that fund had become expensive as the yield on that had dropped over the past year. And we used the proceeds to purchase the two holdings that you see here in the pie chart, both short-term funds, one corporate investment grade and one short-term treasury. So the effect of all that was to really have a more efficient reduction of duration in the portfolio. 6 years versus about 7 in the overall bond market. And also by moving up the yield curve, holding these two funds, the short-term funds, the yields are higher than that floating rate bond fund was. We've actually been able to keep the yield consistent on fixed income at 1.5% in terms of the yield. So the benefit will be as interest rates likely move higher this year, having a shortened or a duration of that's shorter than the overall bond market, that will benefit the portfolio from a performance standpoint and offset some of the losses we're likely to see in the bond market or later this year, and that we've already seen this year. We're going to go to the next page. We'll take a look at performance in the non-salary plan. So we have several time periods here in the fourth quarter, the 1 year. We're also taking a look at the recovery period from at the bottom of when the market was as low as it was in April 20 at the beginning of the COVID pandemic, and then our inception date, which is the beginning of 2020. So you can see the fourth quarter was very strong, just under 5%. A gain of $1.8 million with the value of the overall non-salary plan at $40.7 million at the end of the quarter. The full 1 year returns were 14%, a gain of $5 million. And when we look back to the inception, to the beginning of the recovery after the COVID pandemic in the early winter of 2020, you see the return of the portfolio of 26.3%. For a gain of $13.8 million. And then the inception back to the beginning of January at 14.8%, or just shy of $10 million, $9.8 million during that time period. So we've been in an incredibly strong period for the capital markets over the last couple of years. If we go to the next page, page 5, we can take a quick look at the underlying assets within the pension plan and how they've come together to get that performance that we just saw. Your fourth quarter equities, as I alluded, even though the market has started a little bit weaker this year, we had a return in the equities of 7.2% in the fourth quarter, led by large cap stocks at 11%. That's a little bit of a reaction to fear from the Omicron variant that came up in the fall, pushed large caps ahead during the quarter. And for the full year, you had a return of 22.4% and very, very strong returns out of all the asset classes, 20+% return over the past year by small, mid cap, large cap, even value stocks. A little bit of weakness in emerging markets. That was due to some troubles in China that Jim might have some comments on later in the meeting. But the recovery period since April 1st of 2020 shows you the benefit of the diversification that the Alesco portfolio has for the pension plan. Small cap stocks are up 52% during that period. Mid caps up 49%, ahead of the performance of the S&P 500 at 44% here in this particular column. So that gives you a 41% return on equities over roughly the last not quite 2 year period. And then since inception, which was the beginning of 2020, almost an 18% return. And large cap stocks have been the leading asset class during that time period. I commented on the impact of rising interest rates. If we go down to this next line, looking at fixed income, you can see there's been some slight losses in fixed income holdings over the quarter and the past year, down about 1.49%. But that shortened duration that we've had has had a little bit of a benefit on the performance, not dramatically, but just slightly. And even since the bottom of the pandemic, a slight outperformance of the Barclays Aggregate Index, 1.58% versus 1.49 during that period. And then we're very close, right on top of the Barclays Aggregate benchmark for the inception period back in beginning of 2020. The final comment about...
Tim, just to interject, I'm sure it's not lost on this group that the increase in interest rates that we're seeing, while it's having a very moderate impact on the results of your investment account, from a discounting standpoint, the liability, the pension plan liabilities will be dropping, and so on a net basis, it's very likely that we'll come ahead in terms of looking at your funding levels relative to the liability.
Thanks, Jim. And then just also related to the fixed income holdings, offsetting some of that decline is the impact of the performance of the real return assets, the inflation protected securities. You see that here on this last line, the performance, just if you look at the 1 year period, 5.7%. The increasing inflation expectations that we've had in this economy, you can see that not just expectations, but the actual increase in inflation at 7% over the past year has helped us to significantly outperform traditional bonds. So again, benefit of a well-diversified portfolio with exposures to these different asset classes has helped offset some of that fixed income decline, particularly from a diversification standpoint. And that's been helpful really back to the inception when we've had a 9% return out of the real return assets. Any questions at all related to the performance of the non-salary plan?
On the fixed income portfolio portion, what is the current return that portion we're earning on that? Meaning the income divided by the amount of assets.
Yeah, I've got the yield in terms of the overall fixed income. So it's fixed income is at 1.6% for the yield, with an average duration of about 6 years. If you include the tips within that calculation, the average yield is 1.5%, and the yield is just under 6 at 5.9. That's when the tips are included.
Thank you.
Yep. All right. If we could move on to the salary plan on page 8. The holdings are what we're skipping to right now in that portfolio. In the interest of time, I'll go through these, the salaries and the Utica plan a little bit quicker since they're all allocated the same way. But you can see 65, almost 66% equity here, fixed income and the real return all well within the IPS range, and a similar allocation to the non-salary plan. We move to page 9. Asset allocation. So activity here, exactly the same as in the non-salary plan, about 70% domestic, 30% international, about half of the equity assets and large cap, the rest spread down the market capitalization spectrum. Again, no changes here. We move to page 10. You'll see that we also make the fixed income trade in the salary plan, now compromising about 80% of this fixed income holdings in the broad bond market, split the rest 10% each in the short-term corporate investment grade bond funds and the short-term U.S. government bond fund. Page 11. Again, looking at the performance here in the salary DB plan, similar 4.8% return in the quarter, 14% for the year, gain of almost $5 million in the year. The plan is $39.5 million was the value at the end of the period. 26% return at the for the recovery period from the COVID bottom of the COVID pandemic, and just under an annualized return of 15% going back to the inception in 2020. Go to page 12. See the same relationship in the holding. Very nice gain in equities in the fourth quarter of 7.2%, 22.4% of the year, above 40% for the recovery period, and just under 18% annualized return for the equities going back to the inception. Some slight losses again in the fixed income that we talked about in the previous report, and this outperformance from the real return assets you see on the last slide. Then finally, we'll touch on the Utica plan. On page 15. Utica plan has the same asset allocation, 5.6% equity, the inflation protected securities in the green pie at 6.6%, and fixed income and cash running just under 30% for the overall allocation when you put those two together, all within the IPS ranges. Next slide, 17. Same allocation for equities at 50% in large cap stocks with down the capitalization spectrum and about 30% in international. No changes to this allocation. Page 18. View of the fixed income. We also made the fixed income changes in the Utica plan. Page 19. Returns strong to the plan. Assets at 11.4 at the end of the quarter. Gain of just under 5%, $525,000 here. The 1 year returns, 14%, 26% for the recovery period, and then we're just, again, shy of 15% return annualized going back to 2020. You can go to the next page. Again, same relationship that we talked about before. Strong returns for equities. In terms of the top line, the middle line, a little bit of a few losses there in fixed income, and then the real return assets outperforming as well. Any questions related to the performance or those accounts? If not, we can scroll forward to page 23, and I'll turn it over to Jim. Oh, you don't have the...
We don't have the full deck, no.
So we do have some comments related to the capital markets review that some of you with the hard copies might have in the room. So,
Yeah, Tim, are we able to share your screen, Tim?
He has not given me the opportunity to share the screen.
Hold on 1 second. Let me try another one.
All right. Well, I'll tell you what, so some of you may have this in front of you, some of you may not. I'll just, I don't think we have a huge amount of time left anyway. Maybe 10 minutes, is that about right?
Yeah.
He's given me the opportunity to, Jim. I can share it for you. So get started and I'll pull it up.
Yeah, so as Tim had mentioned, the last few years have been very strong for equities. Want to talk about why that is? And these are themes that we had discussed over the last few quarters. So there's nothing new here. If we go to the next slide, Tim, assuming everybody can see the slide and looking at looking at corporate earnings. Corporate earnings have been very strong. They've been driven by consumption. Consumers have been very active in spending at a very high rate. And that's been the case really since the very bottom of the pandemic, since we emerged from the lockdowns in the spring of 2020. Consumers are flush with cash. We'll talk a little bit more about that in a minute. but they've been spending. And then in addition, there's been both corporate spending as well as governmental spending. And so what happens is businesses that have a relatively high fixed cost component, but low variable unit cost of production or service, have great operating leverage. And therefore, when the demand for their goods or services increase, when the top line grows, their margins can improve, their profit margins can increase quite considerably. That's exactly what we've been seeing. Tim had mentioned earlier that the value stocks in last year had picked up a lot of ground relative to growth stocks. That's really what's happened. Those are referred to generally as cyclical companies. Their corporate profits have increased quite dramatically. And then the flip side of it is, as you know, we have a lot of demand and constrained supply, and so that has allowed providers of goods and services to increase their pricing, and those price increases have been able to stick. And of course, that's the definition of inflation. That's what we're dealing with now. And there are clearly some negative ramifications associated with this, and also to suggest that corporate earnings are going to continue to increase in lockstep with inflation is faulty. We'll talk a little more about that in a minute. Next slide, please. So just what's happened here, if you look at the bottom part of the chart here, the bottom chart, I should say, on page 25, you'll see household spending. We had a big drop when the pandemic hit. We had the lockdowns, and ever since then, it's been increasing. The chart above that, it just shows us something that's a very interesting phenomenon as it relates to consumer confidence. So consumers have been spending and spending at an increasing rate. Confidence has not been consistently high. Generally speaking, up until the fourth quarter of last year, consumer confidence was moving inversely to the case count for COVID. And so the black dotted line shows that that inverse relationship relative to the case count, which is the green mountain chain looking part of that graph. You can see how as case counts increased, consumer confidence would drop, and vice versa. But if you look at the far right-hand part of that graph, you can see that that's not the case. What that is that people are simply just getting used to the pandemic and are learning to live with it. And so when the case count information isn't having as negative an impact on confidence. With that said, it doesn't make it makes it less certain, if that is indeed the case, that we're going to have some dramatic recovery or additional expansion in our economy in the event that is what we're currently seeing, case counts decline. So it could be an interesting thing to watch. Next slide, please. So I'm going to go through this relatively quickly. The key takeaway here, we're talking about consumption, which represents almost 70% of U.S. GDP. The bottom chart here shows what's happening. Household net worths have increased very dramatically. We're talking $31 trillion, or a 28% increase in U.S. household net worth over the last 2 years. There have been three drivers to that. The savings rate, which is shown at the top part of this chart, the increase in the stock market, which Tim was just talking about a minute ago. But for most families, the house, the home, it's the biggest asset that people have. And whether you're in central New York or you're in Tuscaloosa, the home prices have been increasing at a rapid rate across the entire country. And so people's net worth are higher, and when people have a higher net worth, they're more likely to spend. Next slide, please, Tim. The second factor is employment. When people feel that their job is steady, that they're not likely to lose their job, or if they do, that they can find another one, or they feel confident they can leave their current job and go to a new employer at a higher rate, people spend more because it's the propensity to consume. People will spend more when they think that their incomes are going to be higher. And that is indeed a valid conclusion for most people. The issue here is the labor force participation rate in terms of part of bringing down inflation. a big component of the inflation factor is the inflation calculations is wages. And well, we have over 4 million of job openings that are more than there are unemployed people. So that we need to increase the labor force participation rate, and that's not going to happen quickly in all likelihood. So the takeaway from this is when we talk about inflation, we may see as supply chain issues are resolved, we may see the price of goods drop some, and maybe considerably. It's going to probably take a longer period of time for the price of people, the price of labor to drop. Next slide, please. Housing market, talk about that, is very strong. Bottom chart here gives you an idea. National basis. This is not at all saying that it kind of goes, the line graph goes down a little bit at the end, slopes down, and then up most recently. That is not, that doesn't at all suggest that prices drop for a little bit. It's just the rate of increase decline, but it's still at a very healthy rate in the mid-teens. Next slide, please. So this is, I'll be brief on this. You're all very familiar with supply chain issues. This also comes back very much to labor. If you think about the port, the container ships off the ports on our east and west coasts, the big issue there is dock workers. The big issue is truck drivers, getting the trucks in to unload these boats. This will be resolved. It's just taking a while to do it, and it's coming at a higher price. So often you hear me say time and again, higher prices, goods, services, people, you name it. That's why these high levels of inflation. For the last month, as we show here, the top left-hand part of the slide, it was 7% year over year, December over December. And the inflation is not, this is not just a food and energy issue. This is across the board. And it's embedded in our system. The question is whether it gets embedded in our psyche, because what happens with inflation, a large part of what makes inflation so heinous is people expect prices to go up a lot, and when they do, they will. And also people expect their compensation to go up a lot, and when it happens, and particularly in a tight labor market, you're going to see employers are going to be forced to respond with higher compensation. So, as Tim pointed out, the portfolio is broadly diversified. We believe the portfolio is very attractively positioned to address a broad array of different types of economic environments. So how are we going to do in a higher inflationary period? Well, we have a skewing. We do have a skewing towards value stocks and towards smaller capitalization stocks. This is not we're not only in value or only in small cap, but relative to how the overall market is positioned, we're a little overweight in both. And so if you look at history, those two parts of the stock market, as this top chart shows, have performed very well in higher inflationary periods. And what can give you more comfort as it relates to this inflationary cycle is that we're coming into it with attractive valuations for both value and small cap stocks. This is evidenced by the lower chart. You can see how relative to the median, which is that little black dash in each bar chart, that's the median pricing, median valuation for value in small cap stocks over the last 15 years. We're right around the median versus large company stocks and growth stocks. Growth stocks are towards their all-time high. So we think the portfolio will hold up quite well as this inflationary, hopefully it's a cycle, plays out. Next slide, Tim.
Jim?
Just briefly, the Federal Reserve, yes.
Just in the interest of time, we're going to need to wrap it up here. I want to leave a little bit of time for questions.
Yeah, okay, absolutely. Yeah, that's good. I think the rest of these slides are pretty much self-explanatory anyway, so good.
Okay, great. Any questions for Jim or Tim?
I noticed on the chart, it says small stocks has been increasing on that. Is that because of the inflation part?
I can't hear you.
Small, I noticed on the chart, it says that small stocks are increasing. Is that because of the pandemic? Am I making sense?
Jim?
Which slide?
You asked about,
On the chart on page 31.
I think the question, Jim, was related to why is it that small cap stocks are increasing?
Right.
yeah, smaller companies and value stock generally have more operating leverage. So they have, when the revenues increase, they have the ability to increase their profitability faster than other businesses.
Okay, thanks.
Any other questions? All right. Thanks, gentlemen.
Thank you.
Yes, thank you.
Good to be with you. Thank you.
Ms. Masengo has a change to the salary defined benefit plan, which she would like to present at this time.
Good morning, everyone. As you are aware, in 2011, we closed out the defined benefit plans, and what we did is we opened up defined contribution plans to all of the employees at Central. Today, I just want to talk about the salaried defined contribution plan, which is a 401A plan. This is where the employer matches what the employee is already putting into their New York State deferred compensation plan. At this point, we currently contribute 3 to 5% to the employee's match. What we're looking to do today is to increase it up to 6% for the employee. We're looking for this to be effective February 1st. This way, this will equal out. The non-salaried employees had an increase to their 401k match with the union contract that went into effect. So that's why we're looking to increase the salary to the 6% match. We're looking at, it could be an additional $28,000. That's if everybody was to contribute the max of the 6%. Right now, we're probably about 50% of those employees who are only contributing the max.
I like
So,
that, I like that for retention. I think it's a nice benefit to help retain employees.
Absolutely.
And what was the vesting in GMP for that?
It's 5 years.
5 years, 100% vested?
Yes.
Yep, okay.
Yep, 5 years. So we would ask for a motion to authorize the amendment for this plan.
So moved.
Do I have a second?
Arlene,
Second by Monty.
Luella,
We're good.
Thank you.
Okay, thank you very much.
Good job.
They're all that easy.
Mr. Chairman, we need a vote on that?
Yeah, so the committee just voted in favor of it, and then you bring it to the full board for adoption.
Yep. So
Very
that
good.
would conclude our pension committee meeting.
Nice job, man.
Give me 1 second to break the video.
Okay, we're just gonna take a couple minutes, and then we'll get right into audit and finance.